Hey everybody, happy Friday. It's PJ here with our weekly market update. Got a number of things to talk about today. Top three things are going to be the gold axis or the new gold axis, and I'll explain to you what I mean by that. Going to have a quick chat about interest rates and then talk about global growth. And then as an addendum to all this, I'm just going to chat about real estate listings as well in Australia because there seems to be a lot of talk at the moment that we're seeing some life being breathed into our real estate market. So, first and foremost, I want to talk about this gold axis. Now, I attended a really fantastic event on, I think it was Wednesday evening on Tuesday evening in the city with ABC Bullion. ABC Bullion is my preferred physical gold supplier. They're located down in the city on Castlereagh Street. Lovely people. Janie Simpson is the MD there. I'm going to actually catch up with her next Wednesday just to find out about some of the new product innovations they've had. But they had a massive event. There was probably 600 people at this event in the city at the Ivy. And there were a couple presentations, but the keynote speaker was a guy named James Rickards, Rickards. He's an American dude, and I have read and listened to heaps of his commentary over the last probably 7 or 8 years. Very, very smart man. Has written a couple of books, Currency Wars. He's just put out a new book called The New Case for Gold. And he's just a very pragmatic, very switched on, very astute man. And when it comes to geopolitical events and all of the stuff going on in the world. Now that I've prefaced that and what a solid expert he is, he gave a short presentation, about 30 minutes, on what's going on in the gold space, what's going on geopolitically, and something that I have talked about in updates, both written and I believe in some of the recordings that I've done, is around this idea that there are a group of nations, specifically China and Russia, which are probably the two big linchpins in this block, but there are others involved. But China and Russia are the big two behemoths in the room that are developing effectively an alternative to the U.S. dollar-based global payment system, which is basically known as the SWIFT system. But for those of you who do not know this, the United States controls and has controlled pretty much since World War II the international payment system. And the way they've done that is through the U.S. dollar. So the U.S. dollar became, at the end of World War II, and shortly thereafter, the global reserve currency. So all trade was required to be settled through the U.S. dollar payment system and settled in U.S. dollars. And up until 1971, it's a brief history lesson for you. Up until 1971, nations could redeem their dollars for gold. So they could physically take their dollars to the U.S. Fed's gold window. They used to have a gold window there at the U.S. Fed. And only nations could do this. You and I couldn't do this individually. Could take their dollars and say, we'll have gold, please, the equivalent of gold. And up until 1971, they could do that. And what was happening is, because the U.S. was the issuer of the global reserve currency and was basically printing a lot of money, they found that their gold reserves were dwindling because nations knew the history of gold being not only money, but a store of value and a store of wealth. So they were redeeming gold hand over fist. In fact, at the end of World War II, the U.S. had something like 22,000 tons or thereabouts of gold in their vaults in Fort Knox and probably the U.S. Fed in New York. And by the time Nixon closed the gold window in 1971, the U.S. gold reserves had dwindled down to what they are currently reported at, which is about 8,000 tons, a little over 8,000 tons. So that just shows you what I suppose people thought about gold back then. And they realized that many nations realized that if the U.S. had the printing press, which they did and still do, that they could just print currency and they would erode the value of the currency, that it was better to get rid of the currency and have gold. So that's just a little bit of a history lesson around all of that. So what's been happening, say, over the last 20 or 30 years is the United States And when I tell you this, it'll probably the penny will drop. But the United States has thrown sanctions, economic sanctions out on everybody. They've sanctioned countries in the Middle East. They've sanctioned China. They've sanctioned sanctioning Iran, Turkey. They sanctioned countries in Latin America. And effectively, the sanction is this: they stop them from using the U.S. dollar payment system. So they tried to bring economic pain to that country by effectively kicking them out of the system for a period of time, so that they can't trade, they can't sell whatever their goods are. Well, predominantly they're manufactured or they're resource goods. They can't sell them to other countries because they couldn't clear the payment to the U.S. dollar payment system. Very effective weapon, and it typically brought those countries to bear in terms of whatever the U.S. was trying to get them to do. Now, this is obviously grated on a number of countries, and it's like anything, it's a slow burn with these things. But China, who is one of the largest trading partners of the United States, and certainly the second largest economy in the world, and Russia is also up there in terms of it's more of an energy-based economy, but they certainly they do a lot of trade with Europe as well as the United States and China too. But they are effectively saying to the U.S., guys, look, we don't like what you do. We don't like how you behave with sanctions and jerking countries around economically. We're going to set up a system that is backed by gold, number one, but it will be a digital currency system, or it'll be a digital trade ledger, so that what will happen effectively is that if China sells goods to Russia, Russia sells goods to China, at some point, might be once a quarter, once a month, whatever, they will net off the trade that took place, and then they will settle that. And so all of this will be tracked in the digital ledger, trade ledger, and they will net off the difference in gold. So, pretend like there's a gold vault somewhere, say in China or Russia or wherever, and they'll just take the name tag from, this is the gold pile for Russia, and would just, change the name to China for, a ton or 2 tons of gold or whatever. If that's, it just depends on who owes who, or they move it from one side of the vault to the other to say, China owes Russia, 1 ton of gold this month to settle up their trade. So anyway, very effective system to effectively say to the U.S., we don't need you anymore. We do not need to use the U.S. dollar anymore. We're going to use gold, and we're going to have this digital trade ledger. And Mr. Rickard's point of all this was to say that, first of all, to do that, you need to have a lot of gold. So China and Russia have both, their central banks have both been buying tons of gold, literally tons of gold, over the last decade. They have been net buyers of gold. China has not reported its official gold reserves since I think 2 or 3 years ago. I think they had last reported 1,600 tons, but there's a strong belief that China has vastly more gold than that in their vaults. They are actually, you may not know this, I know I've written about this, but I'll just say it again real quick. China actually is the largest miner of gold in the world. And I believe Australia is number 2. But try this on, right? China, not 1 ounce of gold that's mined in China leaves the country, and yet they're the largest miner of gold in the world. Now that's got to tell you something. They are hoarding the gold. Now, none of this is going to happen tomorrow, although it could, I suppose. They could come out and say, oh, boom, we've got a new system, and here we go. It'll probably come in, be phased in some way over the next 5 to 10 years. I suppose it depends in large part on what happens with the U.S. and China trade negotiations, because if you have been paying any attention, I'll just drop a screen on you here. This is the CNBC website, and I know my picture's in the middle of the thing there, my video thing here, but anyway, look at these headlines, right? Huawei is one of the largest telecommunications companies in the world, and there's been this issue between the U.S. and Huawei over their technology and whether it has, spying stuff and all this sort of whatever. Could it be true? Who knows? Probably is. But do you think that Apple in the U.S. do the same thing to the Chinese? Of course they do. So, I just laugh at some of this stuff. But nevertheless, Huawei is one of the largest companies in China. largest technology companies, and the U.S. is jerking them around. China is threatening countermeasures. They're talking about recession in the U.S. I'll come to that in a minute. We have Asian stocks, mixed because of tensions between Japan and South Korea. My point of all this is to say that there is a lot of uncertainty right now in Asia. I mean, we have Hong Kong still, civil unrest there. Who knows what the Chinese may do there to take control of that city-state effectively. And so there's a lot of, things that are not right in the Asia-Pacific region right now. This is having ramifications on global markets. So Shanghai, which is China, the Hong Kong stocks, Kospi, which is Korea, Japanese stocks, all of these stock markets are not doing particularly well at the moment. And they are foretelling a potential, global recession, although you don't necessarily have to have the definition of a recession, which is 2 quarters of negative GDP growth, to actually be in some form of recession. You could just have an extreme slowdown. But my point of all this is to say that some catalyst is going to probably trigger the Russia, China, Venezuela will probably be part of this. Iran will probably be part of this. Gold axis will probably trigger that to occur. And when that does, gold will have to be repriced. It cannot be $1,500 US an ounce. It will go up to some other figure. What that is, I don't know. It could start at 2,500 an ounce, could go to 3,000, could go to 10,000. It just is. We just have to wait and see. But what I'm trying to really articulate to you is that you need to have gold in your portfolio of some description. It doesn't need to be a huge percentage. I reckon 5%, physical holding or exposure to some sort of gold holding is sufficient. I do think everyone should have some physical metal in their possession. So certainly talk to me about how to do that. And once I have a meeting with Janie Simpson at ABC Bullion, I believe they have a new Gold Saver type account, which is allocated bullion, which doesn't cost any money to store. But I'm going to get some deets on that, and then I'll mention that to you in my next update. But just pay attention, I guess, is all I ever really ask you to do in these updates. I'm trying to bring your attention to some of the key things that are going on in the world, but just pay attention to what's going on, and you'll have a much better go of it. So that's enough on the gold axis and what's going on with China. The U.S. just continues to be a complete Muppet show with that stuff, and I think it will resolve in some shape or form later on this year as we get closer to some key events, particularly election cycles in both the U.S. and China. So we'll see what happens there. Now, interest rates. Let's talk about interest rates, because this is a fascinating situation that we're in at the moment. Interest rates globally continue to fall, and I'm just going to drop on a page here on CNBC. Some of you may have heard of this term called yield curve inversion. That is just a fancy way of saying that the short end of the yield curve, so things like, as you see on your screen here, the U.S. 2-year Treasury, the 5-year Treasury, so shorter term government bonds. When the yield curve inverts, it means that the shorter term bonds and bills yield is higher than the long-term bonds and bills. And one of the ratios, or one of the relationships that a lot of commentators look at, is the U.S. 2-year and U.S. 10-year relationship. And what has happened, it isn't currently, but it did earlier this week, the U.S. 10-year yield was higher. Did I say U.S. 2-year? I hope I said U.S. 2-year yield was higher than the U.S. 10-year yield. And as you can see, there's only 0.002 basis points right now between the two as of, whatever it is right now, 3 o'clock in the afternoon, Sydney time. And there's still a ways to go between the 30-year and the 10-year or the 5-year. So there's still quite a bit of margin there. But even as you can see with a 3-month Treasury, its yield is almost 2%. And here's the 2-year, the 5-year, and the 10-year all well below 2%. In fact, hovering in the 1.5 to 1.6% range. So the point I'm trying to make on this is that When this has occurred in the past, and it doesn't happen very often, so it's a very unusual event to occur, it has typically preceded a recession in the United States. Uh, Again, you don't have to have a recession to still have the, I suppose, the conditions of a recession. But this is something to watch very, very closely. I'll just highlight while I'm on the subject of interest rates, you have a number of countries that have negative rates. Now, I've been talking about this for a bit, and I just wanted to mention it again because it's such an absurd situation. I mean, look at Germany, right? This is Germany government bonds. And all across the entire spectrum of German government bonds, they are negative yields. In other words, you give them $100 today, and in 30 years, they're going to give you back 99. Hello? Who would do that? Who would take that trade? It is unbelievable that anyone would take that trade. So this situation cannot persist well, I suppose it can, right? Markets can always continue doing stupid things for some period of time. But this is a highly, highly, highly unusual situation. In fact, we've never been at this point with negative interest rates in history of money. Other countries are having similar situations. I don't know that France has. Yes, France does across a good portion of their curve, up to 15 years, their negative rates. And then you get out to a 30-year French bond, and they're going to give you 0.5% yield. I mean, they're not even beating inflation in these countries. Inflation is probably somewhere between 1.5% and 2% in most of these places. Japan, similar story. Negative yields across most of the curve. And then nothing, like 20 basis points for a 30-year Japanese bond. It's just insanity. We're probably one of the few countries in the world that doesn't have that situation, but look at these yields. I mean, even our government bonds, if you were the government right now, right, try this on. If you were the Australian government right now, and you could borrow money for 10 years, raise money for 10 years at 0.97%, so let's just round up and say 1%, mate, you'd be just borrowing money hand over fist and doing infrastructure projects and reinvesting in the country and trying to, make Australia just a powerhouse on technology and state-of-the-art industries around technology and rebuilding our infrastructure, building new infrastructure. But are we doing that? Not doing it. It's just crazy. Furthermore, if you are a saver, let's say you're a retiree and you need to get yield, you're going to buy a 10-year Australian government bond? I suppose you would if you're worried about getting your money back. But when you do get your money back, your purchasing power is going to be absolutely torched because inflation in this country, the target for the RBA, 2 to 3%. The RBA has basically said to you, if you're a retiree listening to this, I'm declaring war on you as a saver and a retiree. In fact, I want to ensure that goods and services every year cost 2 to 3% more than if you are a fixed income investor, that sort of thing, and you own government bonds, that your purchasing power I'm going to guarantee that your purchasing power is going to be less in 10 years than it was today. Have fun in retirement. I mean, that's the deal that they're giving many, many Australians, and it's absolutely absurd. So anyway, I just thought I would show you some of those bond markets around the world and how absolutely ludicrous the situation is. Let's just move on to global growth. And I don't actually have any charts or anything at the moment, but to show you. But what I can tell you is the metrics and the other things, the information that I get on a day-to-day, week-to-week basis continues to show deterioration in a couple of key things. One of them is the Purchasing Managers Index, which is a measure of manufacturing growth around the world. Many, many, many countries are below the 50 line, so it's a 0 to 100 scale, and above 50 is generally seen as economic expansion, and a reading below 50 is generally seen as an economic contraction in those countries. And obviously, if the slope is, if it's rising and it's going to push through 50 and head up, then that's a positive thing because it shows that growth is coming or it's expanding, and commensurately, if it's declining and it's dropped below 50, that's bad. And at the moment, over the last, 6, 12, 18 months, it has been declining, and in many countries, it's dropped below that 50 mark. So we're not out of the woods yet with global growth. And I'm just going to flip on to another page here real quick. At the moment, I mentioned this in one of my last updates, there is the annual powwow in Jackson Hole, Wyoming, where the Fed and where the Fed meets. The G7 has also had a meeting recently. That's the U.S., Canada, Japan, Korea. There's a few. I can't think of all of them off the top of my head, but basically all the big economies in the world have met. You have some European economies in there, the UK, and they are in. There's discord there. There's disagreement and discord amongst the G7. So Friday is going to be interesting because Powell, and this article here, if you're interested, go to CNBC and read this article. It's very interesting because the poor guy at the moment is really between a rock and a hard place. The Federal Reserve Board in the U.S. Is divided in terms of what they want to do around interest rates. Some of them think we need to cut and cut quickly to quote unquote avoid a recession. Others feel as though before they cut any further, we need to see economic data deteriorate. So economic data in the U.S. isn't as bad as it is everywhere else, but it's getting worse. And it really just shows you what, and I've said this many times in a lot of the stuff that I do around the reserves, the central banks of a lot of nations. They just don't know what they're doing. I mean, it is absurd that the president of the United States and economic commentators would be saying, "Oh no, you need to cut rates to avoid a recession." When recessions occur, for those of you that have lived, through a number of cycles, you would know that recessions come along, and they are a cleansing mechanism in the economy. We need to have them. They have to occur. It is part of nature. Really, I think it's part of natural law. It's almost like saying, we're never going to have nighttime anymore. We're going to stop the rotation of the Earth so that I guess one half of the planet would be in daylight and the other would be in darkness. But you get the point, right? Is you can't stop the world turning on its axis. If you were able to do that and you did do that, it would be catastrophic for the planet. And I suppose that analogy holds true for economies. If you do not allow recessions to do their job of cleansing the economy of the excess and the bad businesses and the bad decisions that took place, then you cannot set up the economy for the next level up, which is the next expansion. And this has been going on now for the last 20 years. I mean, it started with Greenspan, it went to Bernanke, then to Yellen, and now to Powell, where everybody seems to be trying to flatten out the business cycle so that we actually don't have one. And that's absurd because you have to have a business cycle. Many of you know that because I've been talking about it for a while, and many of you know that anyway. So look, I think the point of all of this entire rant that I'm giving you today around these topics is that we live in unprecedented times in terms of what's going on economically and where we are in terms of many things in the world that are out of balance, and the fact that we have never seen these conditions ever before in human history. And so when those circumstances are occurring, it just means there is greater likelihood that something can come out of left field and really disrupt the flow of life and of economics and of finance and everything else. So we have to be ready, and we have to be armed for that as investors and as stewards of our own capital. Last thing I'll just quickly mention, I don't know if any of you pulled the real estate section out of maybe your local paper or the Sydney Morning Herald or whatever on the weekend. And I noticed the other day, we get the Manly Daily in my local area, and it's it's quite a large distribution area, and the Manly Daily has typically the real estate section. There's a little glossy color real estate booklet in the middle of the Manly Daily on Saturdays, and I've been I've been looking at it for the last better part of the last few months just to see what's going on with prices and so forth. And the other day, I pulled it out. I think it was about a month ago, and I pulled it out of the paper, and I'm like, this has got to be the fewest number of pages I have ever seen in one of these real estate sections. And I counted them. There were 14 pages. That's it, covering the 500,000 to 600,000 households that are in the distribution catchment for the Manly Daily. And I thought to myself, wow. I remember back in the peak of the real estate market, um, many years ago, that thing would have been 100 pages. It was chock a block with listings and other things. And I thought, here we are, 14 pages. Anyway, a week later, I grabbed it and I looked at it, and it was 21 pages. So I'm not counting what's advertising or anything like that. I just figure, well, if it is expanding, then that's probably a sign that more vendors, at least, are accepting that we're in the market we're in is the market we're in, and if they need to sell, they're not going to hold out for some sort of recovery, whatever they need to sell. So I thought it was an encouraging thing to see the size of that document begin to increase, and it made me wonder if we might have seen a bottom in the real estate market here, and whether we're stabilizing around credit and other things that are now loosening up a little bit. I think the answer is probably yes, but time will tell. Time will tell in all of these things. I think that is about it for today. That is a lot, and there's a bit of heavy stuff in there for you. So I do hope that you have a fantastic weekend. Please remember to shout out to anyone that you think might need a phone call from you to say, hi, how are you going? Are you okay? And if anyone has any questions about anything in this video, please give me a shout out or leave a comment below in the comment section, and I'll see what I can do to get back to you on that. Have a wonderful weekend, and I will hope to see all of you very soon.